Thank you. Thank you, Cammie, and thank you all for your stamina. You've made it almost to the end. The reward for your persistence is 20 minutes of economics. Or punishment. That may be up to you, but fortunately I am. And I didn't notice this till the second coffee break. I'm assuming that Angela at Capital Chart Room or some of her colleagues actually did this, but my name tag actually says most entertaining economist on earth. Angela's lifting a thumbs up in the back. That's kind of a low bar, if you think about it. I mean, I'm gonna paste this into my notebook. Basically, what I understand that to mean is of all of the entertaining economists on earth, which is, I don't know, not that many. I'm in there at least. How many of you, Cammie asked the question at the top of the morning, and I didn't catch the show of hands. How many of you were here last year? Not here, but at the event last year. Okay, quite a few. Okay, good. How many of you remember what I said last year? Oh, good. Okay, that makes my job a lot easier. I will tell you, because I'm an honest economist, every time I do one of these gatherings repetitively, I go back and look at the presentation that I gave usually the year before. It keeps me humble. I try to learn from it because making these kinds of presentations is always a humbling exercise. The content last year was really twofold. We were talking about the looming economic recession, how bad it would be, when it would come, whether it was already here, how painful it would be. How many of you remember the Great Recession of 2023? Got that one wrong. It just didn't happen. The other thing that we talked about, interestingly enough, was the looming debt ceiling crisis and whether or not the United States was going to get through it, whether we're going to default on debt. It was a pretty depressing kind of presentation last year. I think it's a little better this year, and I'm going to go to the presentation now, because the economy in 2023 not only did okay, really all aspects of the economy did okay. The headlines across the top, those big black numbers, are quarterly GDP growth, and by convention, those are expressed as at an annualized pace. So you can see that last year, and this is the last 5 quarters, last year the economy started off with a growth rate of a little over 2%, actually accelerated into the fourth quarter and the third quarter of last year before coming off a little bit in the first quarter of this year. That's the last set of bars. The bars represent contributions to GDP growth. And remember, there are 4 drivers of GDP growth, of which far and away the most important is the red bar, personal consumption. That's 68% of GDP. Business spending is a close second to that, followed by government spending in green, and then the mustard-colored bar is net exports. And it's interesting to see that in the first quarter of this year, basically all of the weakness in the economy, I'm going to use the air quotes, weakness, because it wasn't a whole lot of weakness, was net exports. And if anything, ironically, and maybe a little counterintuitively, that actually speaks to the strength of consumption. When we import and consume more things that are manufactured abroad, that's someone else's GDP. The D stands for domestic. So if you buy a German car, that's someone else's GDP. Unless the car was built in Tuscaloosa, Alabama, in which case it's our GDP. So it gets a little bit difficult to untangle that. The important thing to notice is that for most of last year, and indeed into this year even, most of those bars point up. So not only is the economy doing okay, it really is kind of firing on all cylinders. I'm going to focus in on the personal consumption part of this dynamic because, again, that's the most important part. That's 68% of the overall equation. I'm going to take a little bit of a detour and look at business and industrial manufacturing sentiment as well because there are some different things going on there. I'm going to tie that into monetary policy and interest rates, which are important for anyone owning, operating, running a business. And then as I round third base into home, I'll make a few comments about financial markets, stocks, and bonds, and then I will take a breath, and hopefully Cammie will give me enough time to answer some questions at the end of it. I'm going to look at 3 drivers in particular that I think will continue to support economic activity into 2024. The labor market, the housing market, and general trends in inflation. So first, the labor market. This is a sign of success. These are monthly job gains, the blue bars here, and then the red bar is the unemployment rate. The very left-hand side of this graph still captures a bit of the recovery from the pandemic, when there was a whole lot of job growth. It wasn't really job growth, it was more job recovery. So that wasn't a sign of underlying economic strength as much as it was a sign of just a bounce back from the 2020 hit to the labor market. But nonetheless, we have continued to add over hundreds of thousands of jobs a month. That has enabled the unemployment rate to linger below 4% now for 26 consecutive months. That is the longest stretch of time the unemployment rate has been that low, going back to the 1950s. The economic linkage here is pretty straightforward. That's just more people with more jobs and more money in their pocket and more security in their jobs, and therefore a greater psychological willingness to spend that money. That's the heartbeat of economic activity. What is it that continues to propel such a robust labor market? As is the case with most of economics, it comes back down to supply and demand. And in its essence, what continues to drive the labor market is there is simply more demand for workers than there are workers able to fill those jobs. The red line on this page is unemployment, or the available supply of labor, expressed here not as a percentage rate, which is how we usually think of it, but just sheer numbers of people. The blue line are job openings. The graph kind of tells the obvious story. There are 2.1 million more job openings than there are people available to fill them. There is an imbalance between supply and demand. Anytime this is the case, I don't care whether the market is pork bellies, orange juice futures, or people. That's a tight labor market, and that says to me, as we head increasingly into the middle of 2024 and beyond, we'll continue to see decent job growth. Again, more people with more jobs, more money in their pockets, and more willingness to spend it. Now, that gap is narrowing. This is the only graph that makes a reappearance this year from last year, and when I showed you this graph last year, the gap between those two lines was more like 5 million jobs open more than people available to fill them. So it is narrowing, and part of this is getting back to, let's call it post-pandemic normal, whatever that means. As that narrows, I do think some of the strength in the job market will begin to wash out. Just anecdotally speaking to some of you today, and some of you have said to me, it's a lot easier to hire people now than it was a year ago, or 2 years ago, or 3 years ago. This is why. It'll probably be even easier a year from now. So these trends do not last forever, but while they do, this continues to be a tailwind to economic activity. A second tailwind, which is really counterintuitive, is the housing market. Now, housing is very regional. So the prices of houses year over year change from region to region. The red bar in the middle of the page is the nationwide average. Year over year, the average price of a house in the United States is up 7.5%. This is a whole range of major metropolitan areas. At the far right-hand side is San Diego. Home price is up 11%. The far left-hand side, Portland, Oregon. I'll pause and let you fill in your own Portland, Oregon joke there. There's the greater Dallas area in green, if you could make that out, up 3.5% year over year. I'm guessing some of you could tell me that prices are up a lot more than that depending on where the house is. So yes, everything is regional. Here's the remarkable thing about this. If you had had a perfect crystal ball maybe 3 years ago and said to me, boy, have I got bad news. The Federal Reserve is about to raise interest rates from practically 0% to 5.25%. They're going to do it quickly. Mortgage rates are going to go from 3 to 8. That's catastrophe for the housing market. That's Armageddon for the housing market. And yet, here we are. How can that possibly be? Well, here's the conventional mortgage rate. And I think, as Isaac said, we look at 7.5% mortgage and we think that's a big mortgage rate. It's not. This is a graph that goes back 20 years. If you pushed it back further than that, I'm sure there are people in this room who can wax nostalgic about the deal they got with their 16% fixed mortgage 30 or 40 years ago. But nonetheless, that rapid rise from 3 to 8 and now back down to 7.5 ought to have been real detriment to housing market, and it wasn't, for the following reason. In this country, mortgages are largely fixed. And if you were lucky enough, or smart enough, to have locked your mortgage in 3 years ago, or 5, 7, 9, 10, 12, 15, almost anywhere within this graph, your mortgage rate isn't 7.5%. Your mortgage rate is lower than that. I could ask for a show of hands, but I'm guessing those of you who have mortgages, there could be some 3 or even 2 handles in this crowd, depending on when you refinanced. And if you average that out for the entire country, although the rack rate mortgage today is 7.5, the average rate people are actually paying is 3.8. That's a big difference. That's a huge difference. This is not true everywhere in the world. I started my career living and working in London for Brown Brothers Harriman. In the United Kingdom, mortgages are almost entirely variable, and they reset monthly. Exactly. Bank of England raises interest rates, your mortgage payment goes up next month. So in economic terms, the translation effect of interest rates into the real, live, honest-to-God economy is really quick. In this economy, it's really slow. Think about what this means. All else being equal, when mortgage rates rise as rapidly as the red line on this graph does, the demand for housing does what? It goes down. But all else is not equal. Work through the following simple thought experiment with me. You're sitting in your house. You were lucky enough to refinance 3 or 5 years ago, so you've locked in a 3 handle on your mortgage. You'd kind of like to move to the other part of town. You could use an extra bedroom or something like that. But to make that move is to trade from the blue line to the red line. You going to make that move? No. So although the demand for housing has certainly fallen because of interest rates, the supply of housing has fallen further. Once again, our old friend supply and demand comes back. Existing homes for sale on the market is now lower than it's been at any point in the past 25 years. By the way, the global financial crisis is obviously in the middle of that. At about 1 million units, existing homes for sale is at an all-time, I shouldn't say all-time, but about a 30-year low. New housing starts helps somewhat, but even if you add these 2 lines together, and you probably shouldn't, that would probably double count some things, but let's do that anyway. We're among friends. So if you add those lines together, you get a total housing supply of about 2.3 million units. That's half of what it was 15 years ago. Once again, in any market, if the supply of something drops faster than the demand, that's an underpinning for the market. And so the reason that housing prices have held up isn't so much the demand side of the function, it's the supply side of the function. This, too, is likely to change. I'm going to go back 1 slide, and you can see that these lines are narrowing a little tiny bit. People do have to move. They do have to refinance. That average effective rate, the blue line, is beginning to converge, but extraordinarily slowly. This says to me there continues to be a tailwind for housing prices. The reason that's important is that if the vast majority of Americans count on a job for their income, for the vast majority of Americans, the single most valuable asset on their balance sheet is their house. And whether or not you intend to sell it or need to sell it, psychologically, the confidence in the value of your house, the knowledge that it's probably rising in value, makes you feel richer, and it makes you act richer. And again, that's 68% of economic activity. The third dynamic, and this is a little bit more of a forecast because it's not quite fully happened yet, is relief on the inflation front. You're looking at the good old-fashioned consumer price index. You can see a peak in the summer of 2022 at about 9.1%. Since then, a kind of patchy decline down to the current rate of inflation of 3.4% as of April. I've broken these out into the contribution to inflation from food and energy, that's the red part of the graph, and then the everything else, the so-called core inflation, is the blue part of the graph. And I do that for 2 reasons. One reason is that's the way the Federal Reserve looks at it. The Federal Reserve is really focused on the core inflation because that's the inflation that tends to be stickier and more systemic. The other reason I break it out is that most people experience inflation through the red part of this graph. I'm an economist. I experience inflation through spreadsheets. That's weird. Most people experience inflation at the grocery store and the gas pump. That's the red part of this. The fact that food and energy prices have been disinflationary for the past, should add those up, 14 months, I think, says to me that there is some relief taking place on the inflation front. Now, I know what that means is that prices went up a long way. They've not come back down a long way, but they've stopped rising at the same pace. At the margin, that's good for consumer sentiment. What I'm watching very closely is what's happening with the blue part of this graph, the so-called core inflation. And there I think there are 2 interesting and related dynamics to watch. So some context, this is all the April inflation data. It's all year-over-year comparisons. So on the very left-hand side in red, that's the headline consumer price index, up 3.4% year-over-year as of the month of April. What that literally means is that the average basket of goods and services consumed by the average American family in an average month cost 3.4% more than it did in April of 2023. If we begin to break that down a little bit, energy prices next up 2.6%. That's all energy, the whole energy complex. Food prices up 2.2%. And if you back those out, everything left's up a little bit more. So the core rate up 3.6%. That's inflation minus food minus energy. What's driving that? I have handpicked a couple of dynamics here. This is not the whole pattern. But I'm really interested in what is it that continues to be so inflationary. The tallest bar on this page is a year-over-year change in auto insurance policies. Anybody renew an auto insurance policy lately? The bar will be open later on today. Your rate went up, nationwide, 22.6%. Now, the good news is that's not a very big part of the pie. That's only 2.9% of the inflation basket. In other words, 2.9% of the average budget for the average American family, et cetera, et cetera. But if I multiply those two numbers together, what it yields is that 0.7% of the overall inflation rate is auto insurance alone. So if I back that 0.7 out of the all items, the red bar on this page, inflation comes down to 2.7%, just because of auto insurance. That one thing is that impactful. Even more impactful is the cost of shelter, putting a roof over your head, whether it's rented or whether it's owned. That is understandably a big part of the basket, 36% of the basket. That's up 5.5% year over year. If I do that math, that's 2 percentage points of the overall inflation. So those two things alone add up to 2.7 percentage points of the 3.4% inflation. So if I were to dial those down to zero with my magic economist wand, inflation isn't 3.4%, it's 0.7. Now, did you see what I just did there? What I just said, that if it weren't for all the things going up in price, we wouldn't have an inflation problem, right? They teach us that in economics school. That's a cheat, right? That's unfair. What do auto insurance policies and rent have in common? The price of eggs changes every day. The price of gasoline changes every day. Your auto insurance policy does not change every day. When you renew it, that's your policy. When you sign a new lease on an apartment, that's your lease. Those are very lagged and very sticky numbers. So one of the things I'm watching carefully is those two items alone over the course of 2024, the degree to which they can provide some relief on the inflation front. This is the trend in auto insurance prices over the last 25 years. You can see the disruption of the pandemic in the middle. I feel pretty confident saying that when we gather a year from now, auto insurance prices will not be up another 22.6%. There is reversion to the mean, and if auto insurance prices just go back to their normal level of sort of 4 or 5%, that's a huge inflationary relief. Something similar with shelter prices, that's the shelter component, but remember there's a big lag in that. I'm very fond of a very narrow measure that measures the new rents being signed by new tenants at newly built buildings. So that strips as much of the lag out of that as possible. That new tenant rent index is basically at zero. And you can see from this graph, the red line leads the blue line by about 12 to 18 months. So I do believe as this year goes on, we will see more and more inflationary relief that'll be even more of a support for consumption, and very importantly, and I'll come to this momentarily, will give the Federal Reserve the wherewithal to begin adjusting interest rates lower, not in response to any kind of economic stress, but merely in response to further improvement on the overall inflation front. That's all about the consumer. I want to take a glance at business and industry sentiment because there are some differences there. I'm very fond of the reports that the local Federal Reserves, the regional Federal Reserves do that measure industrial and manufacturing sentiment. These are so-called diffusion indices. So readings above zero indicate optimism and expansion. Readings below zero indicate no expansion, indicate contraction even. This is the survey done by the Dallas Fed, and it surprises me a little bit to see that industrial and manufacturing sentiment, and by the Dallas Fed is the much larger than Dallas-Fort Worth. It's the Metroplex and then some. Remains in negative territory, not dramatically so, but there does seem to be some malaise there. I look at other regional Fed. It's true in my region of the country as well. The much greater New York area, which would include a lot of New Jersey and a lot of Connecticut, also in negative territory, a lot more volatility. The only region that I can find with manufacturing sentiment in the positive is the greater Philadelphia area. I find that interesting. I find it interesting to see this real disconnect between a tailwind to consumption, which is good for the economy, and maybe not so much a tailwind in the industrial and manufacturing sentiment. I attribute a little bit of that to inflation, input prices still quite high, maybe uncertainty on global trade, maybe uncertainty on tariff policy, uncertainty with an election coming up this year. Interest rates have been higher now for quite some time to come. So this is something, too, that I'm watching, but it's a part of the economy where there is a real difference between what's happening with the consumption side and the personal side, household side, and what's happening on the corporate side as well. The Fed has to balance all of this out and figure out how to adjust monetary policy accordingly. The primary lever or dial they have for monetary policy, of course, is interest rates. This is a graph of the Fed funds rate. It's a policy rate. It's not a rate that any of us pay. Technically, it's the interest rate that banks pay to borrow money from each other. Obviously, that influences a lot of other interest rates as well. The blue part are historical decisions. The red part is the futures market. The numbers on this aren't necessarily as important as just the overall shape. But you can see the rapid rise from 0 in 2022 up to 5.25% in the summer of last year, and then the indication of a decline as we get into the latter half of this year. 6 months or 9 months ago, this looked a lot more like a bell curve. The expectation was the Fed would be able to control inflation rather handily and be able to adjust interest rates lower a little bit more rapidly. That narrative has changed. Now the expectation is that the Fed will have, having raised interest rates to where they were, have to keep them there for some time to come. And that's exactly what's happened. If you look very closely at the end, the market's pricing in probably 2 interest rate cuts in the latter half of this year. If I had to make a decision, I would say probably 1. This is an election year, of course, and the central bank hates to cut interest rates and hates to raise interest rates too close to an election, lest they be perceived as making a political statement. And they will if they have to, but I think the Fed's in a situation right now where they don't have to because there is not enough economic challenge to require them to lower interest rates, but there's also not enough improvement on inflation to allow them to lower interest rates. I think that that will begin to develop closer to the end of this year. Which raises in my mind the interesting question, how does the Fed know they're getting it right? An interesting question that rarely gets voiced is, what should interest rates be? I'm confident the Fed discusses this behind closed doors. How do we know if we're getting it right? I'm also confident that they answer that question to themselves in real terms. The nominal level of interest rates does not matter, even though that's what we pay attention to. What does it cost me to borrow money to finance a house or to finance a business expansion? It's the relative level versus inflation, the real rate. This is a graph of the real Fed funds rate going back almost 75 years. So it is literally a simple equation, the prevailing federal funds interest rate minus the then prevailing CPI. And what we see is there was a real paradigm shift in 2008. You can divide this into before and after the global financial crisis. Prior to the global financial crisis, the real Fed funds rate averaged 1.76%. So Fed funds minus inflation averaged 1.76%. In the wake of the global financial crisis, the Federal Reserve decided that monetary policy could be used not only to support the economy, but also to support the banking sector. No value judgment on that, but you can ask me during Q&A if you want to. But that resulted in the real Fed funds rate being negative 132 basis points, 1.32% for that 15-year period following the global financial crisis. So although we never had negative nominal interest rates like Japan did and like some Southern European countries did, we did have negative real interest rates. I believe that this Federal Reserve, under the chairmanship of Jay Powell, very much wants to restore monetary policy to what it used to be. And I welcome that. I'm kind of an old-fashioned investor. I believe that money should have a time value, time should have a money value. But look at where we are now, the last data point on this page. With the Fed funds rate at roughly 5.25, and with inflation in the mid-3s, we actually have a real Fed funds rate that is within a handful of basis points of the pre-global financial crisis average. So in some ways, mission accomplished. The Fed will never say the last 60 seconds of what I said. It's way too clear and understandable, and central bankers do not like to be intelligible. I don't know where they learned that, but they all are very good at it. The important part of this to me is it opens the door as when inflation begins to improve even further, the Fed can lower nominal interest rates even further while keeping the real Fed funds rate where they would like for it to be. So that says to me interest rate cuts starting at the end of this year, and if we actually do get back, run the math forward, if we get back to a 2 or a 2.5% inflation rate next year, add 175, 200 basis points to that, and that means that interest rates can continue to fall as we head into 2025. But that's next year's speech, not this year's speech. Let me round it with a couple of comments about markets. This is a pretty good backdrop for financial markets. If you think about decent economic activity translating into corporate earnings, that is happening. The expectation of falling interest rates hasn't begun to happen yet, but will. That's how you get the kind of equity market reaction that we've had this year. I'm very interested, though, in not only what the market is doing, but why it is doing what it's doing. The breadth of market participation is important for me as an investor. So what I'm showing you here is the year-to-date returns of all 500 stocks in the S&P 500. There are 500 blue bars on that page. Trust me on that. Don't count them. That's the S&P itself in the middle. This is as of last Friday, updated this data. So the S&P up 11%, little over 11% year-to-date. That's a good start to the year. To the left of that are the stocks that have outperformed. So 176 of the 500 names, about a third, have outperformed the index. So obviously, the 65% have underperformed. That's the obvious next part of it. How can that be? Why is that red line not closer to the middle? And the answer is, of course, because there are a handful of very large technology stocks that have dominated market performance. It was worse last year than it is this year. As an active investor, I look for that to broaden out. As an active investor, I'm also far more interested in the right-hand side of this graph. It's interesting to me that despite this bull market that we've enjoyed, and don't get me wrong on that, it's nice to see stocks go up, 152 members of the index, 30%, have negative signs in front of their return year to date. I'm a contrarian investor. That's interesting to me. It doesn't mean that all 152 of those stocks are good investments, but there are plenty of stocks that have been left behind in a market that's increasingly dominated by the Magnificent Seven. A little less magnificent than they were last year, but these very familiar household names, Apple, Microsoft, Alphabet, that's Google, Amazon, NVIDIA, Tesla, and Meta, that's Facebook, at the beginning of this year added up to 28% of the value of the S&P 500. Those 7 names. The other 493 stocks were the other 72% of the weight of the index. Just to put that into even more global context, the value of those 7 companies today is worth more than the Canadian, the UK, the Japanese, and the European Union stock markets combined. That's a remarkable statement about, first of all, how good some of these companies are, but how very narrow the market is. And we can measure that if we look at the year-to-date returns of these, and some have fallen off the wagon. Tesla's down, Apple's down a little bit. The others are holding up pretty well. You can see on the very right-hand bottom corner of a total market return of 11.2% as of last Friday. Roughly half of that was accounted for by these 7 stocks alone. So still a pretty narrowly led market. There's good news and bad news in that. The good news is, as an active investor, there are plenty of stocks that have been left behind. The bad news is very top-heavy markets like this tend to be fragile. So I feel pretty confident saying that we're likely to see a lot more volatility in the markets. I mean, think about just the math of one of these large companies like Apple or Microsoft, each 7% of the index, having a rough go. That will translate to the overall index level as well. Still positive on stock markets, don't get me wrong, we're still fully invested for our clients, but we really want to see that that market leadership broadens out over the course of 2024 and 2025. Encouragingly, for the first time in a long time, I'm able to talk to investors about the opportunities in fixed income markets. For 15 years, when interest rates were 0, you can't compound at 0 and make any money. You have to actually have some interest rates, and we do for a change. So I'll draw your attention just to the middle line, the red line on this page. That's the yield curve as of last Friday. It's pretty flat, but across the maturity of the yield curve, you can earn high 4s, even 5% in money market funds, take on a little bit of credit risk, a little bit of maturity risk, you can get that up to 6 or 7%. That's the first time in a long time that fixed income has played a return role in client portfolios. So we've encouraged clients, whether they're ours or whether you have a different advisor, go back and look at that asset allocation and see if it still makes sense in an environment where there's a changed opportunity set. Economic conclusions, I think I've touched on. Just the 4th bullet point here. I haven't spent a lot of time dealing with risks, which abound. They always do. We could spend the rest of the day looking at a long litany of things that could go bump in the night. It's very important to make a distinction between those risks that threaten market sentiment, and therefore prices, and those risks that threaten real economic fundamental activity, and therefore values. A lot of these things, I think, pose more of a sentimental risk than they do a valuation or a fundamental risk. And then investment conclusions here too. I won't read this to you other than a shout out for the fourth bullet point here. One of the trends we're seeing in our own business is that as public pools of capital shrink more and more, and that's largely a function of the banking sector, private assets are more and more interesting. Not appropriate for every investor. You have to lock up your money. Fees are higher. There's a lot less transparency. Private equity, private debt, private credit, those things are playing a much more important role in our clients' portfolios. So I would encourage you to talk to your investment advisor about those as well, whether or not they're appropriate for you. With that, I will take a breath and bring it to an end. And are you going to let me have any questions, Cammie? Cammie says 2 questions, which means you better make them good, because we'll be grading you on that. And it's hard to see with the lights. So are there any questions? I should say, first of all, thank you for having me back again. Invite me back next year and see if this all came true or not. But before Cammie gives the benediction, any questions for me? I'm not running off anywhere. I think there's one back in the back. Yes, of course, right under the light. Right.
So I'm not sure if I'm going to articulate this well, but I have kind of a two-sided question. So the monetary policy for the Bank of England, you had mentioned that they fluctuate with their interest rates monthly?
Right.
Okay. If you could tell me, if you know, the percentage of their foreclosure rates, and then maybe tell me what your thoughts are from their monetary policy to ours, and pros and cons.
So not surprisingly, foreclosure rates in the United Kingdom are much higher because there's a lot less predictability. If I can lock in an X% mortgage in the States, I can plan for that. Our foreclosure rates here, and it's something that I watch very closely, there is no indicator of stress in foreclosure rates in the U.S. housing market at present. So, right, and don't quote me on this, but it's approximately right. Right now, the percentage of mortgages that are more than 90 days delinquent, so this is not missing one payment, this is serious 3 months delinquency, is about half of 1%. And during the global financial crisis, it was 8, 9, 10%. That's about as low as it's ever been. So we're not seeing a lot of stress really anywhere in consumer finance, certainly not in mortgages or home equity lines of credit. We're not seeing it in auto loans. We're not seeing it in student loans, but that's probably a little bit misleading. Maybe a little bit in credit cards, but nowhere else in American financial. But it's higher in the UK simply because it's easier to get into financial trouble when the Bank of England can raise your mortgage payments next month. That's an unanticipated hit to the household budget. One more question, maybe? Heading this way, right.
So you've talked about a lot of aspects of the economy and things driving it and employment, but you didn't address the age of the average worker. And how is the boomer retirement going to factor in, and is it going to help or hurt the economy?
That's a really good question. Another thing that I pay attention to is a statistic called labor force participation, which is what it sounds like, just the percentage of people in any age group actually in the labor force, which means they're either working or they're looking for a job. The labor force participation rate for people aged 25 to 55, so sort of the core of the labor market, is now about 0.7% higher than it was before the pandemic. So the statement like no one wants to work anymore, no one wants to come to work, that's not true for the core demographic of the labor force. Where we're still seeing lower than pre-pandemic levels of labor participation is in early career entrants, people aged 20 to 25. And there's always volatility there because they're taking jobs, leaving jobs, chasing a girl halfway across the country. There's all kinds of volatility there. I get that. The other place where it's not recovered is age 55 and up. So these are people who are closer to retirement, and if you think about the logical fact pattern there, these are people who, not all of them, but for the most part, they've got equity in a home, and I showed you what home values are doing. They've got an IRA or a 401k. We know what those have done. So I think those are people who have maybe accelerated a retirement just because they can. They're financially secure enough to be able to do so. But you raise an interesting question. As labor force growth begins to come down, as natural births come down, this is a real call to wrap it all the way back around to the beginning of the morning. Technology and AI in particular is going to have to step in and take on some of that work, if you will. This is not a new story, by the way. One of the things that I'm most intrigued by about AI is it's a technological story that is, depending on how far back you go, maybe 275 years old. the Industrial Revolution, weaving looms in Manchester, putting people out of work, but also creating whole new industries because of that creative destruction. I think we're just seeing that again as AI comes on board. And it may be at a hyper-fast speed because of the way AI develops, but part of the answer to that increasing shortage of people to work is what economists call the substitution of capital for labor, but more colloquially is known as robots, algorithms, technology, and even AI. What a fascinating time to be alive. With that, I'm going to thank you once again, and Cami, retake the stage, and I'm not running off anywhere, so